So apparently there is a new suitor for MEG Energy. The Financial Post says Cenovus is ready to make a bid for MEG. Strathcona Resources has already made a hostile approach. Our guest thinks Cenovus is most likely the white knight in this situation. Let's bring in Julian Klymocko, CEO and Chief Investment Officer at Accelerate. Julian, great to see you. Thanks for joining us. You think it's plausible that Cenovus could step in and buy MEG here?
Yeah, that's been our thesis over the past couple months. If we rewind to mid-May, Strathcona announced a hostile takeover for MEG Energy worth about $23 at the time, a very skinny 9.3% premium, which is surprising because you don't really see hostile takeovers very often in the Canadian oil patch. Calgary boardrooms tend to be pretty chummy. And then May 30th, the bid got officially launched. June 16th, MEG Energy Board of Directors officially opposed the hostile takeover. In addition, they launched a strategic review of alternatives, which means, Andrew, they put up the for sale sign. Looks like that's all coming to a head. Financial Post reporting that bids are due Monday. And as you indicated, Andrew, the main potential white knight here, and in M&A parlance, that means a friendly bidder to top the hostile offer here would be Cenovus. Which totally makes sense, because if we rewind back to 2018, Husky Energy, back when it was independent, made a hostile takeover bid for MEG Energy, which ultimately failed, but then Husky was acquired by Cenovus, and there's a lot of synergies there because the assets really line up. Furthermore, the Financial Post indicated that Cenovus is seeking financing. So to me, that perhaps indicates that there'll be a sufficient or a significant cash component in this bid. But ultimately, it looks like bids are due on Monday, and we may be chatting about an update on this, Andrew, next week.
You say that MEG has consistently traded above the price that Strathcona has suggested?
Yes, and you ask any MEG shareholder, they've been pretty disappointed with Strathcona's initial offer, which is just at a 9.3% premium. Typically, a takeover bid would have a premium of 25% or higher, and MEG shares indicate that their shareholders are expecting more. It has traded about 8 to 15% above the offer here. So if Cenovus does have an overbid here and launch a bid that's a friendly with a higher consideration, I'd probably expect at least 10% or more above the current market price.
It's interesting. You have a historical note for us. You say the last significant Canadian oil patch deal that was hostile was when Suncor bought Canadian oil sands a decade ago, but that was at a 50% premium to the unaffected price.
Yes, and they did have to bump their bid materially to get a friendly deal done. So that transaction started out hostile, and then ultimately there's no other bidders for that asset. So the acquirer just bumped the price and got a friendly deal in hand. That could happen here, but if you're Strathcona, you're going up against a much larger, a much more financially competitive interloper in Cenovus. So there could be a bit of a bidding war here, but ultimately, I think that the stronger party here could win.
And maybe we can put up a one-year chart for Strathcona. Of course, Adam Waterous, the guy behind that company, has said, well, OK, if we don't get it, we'll pay a special dividend. And investors seem pretty happy with that prospect.
Yeah, and the other thing to consider is that prior to launching its bid, Strathcona bought in the open market a 10% stake in MEG. So if Cenovus comes and pays a big premium for MEG, Strathcona shareholders still win because they own 10% of the target.
I like that. You buy shares in a company, you put it in play. It could work out nicely. Yeah.
Exactly.
Let's move on to Teck Resources. They have, Quebrada Blanca 2 in Chile, a massive development. Something like that's never going to go completely smoothly, but they are having more glitches there, it seems.
Yeah, so Tech came out with their Q2 results, and when you're a shareholder and you're looking at quarterly results, a good thing that happens is when they beat and raise, that means beat street expectations in terms of financial results and raise guidance either for the year or for the subsequent quarter. Now, with respect to Tech, unfortunately for shareholders, they did the opposite. They missed consensus expectations on both revenue and production. In addition, they cut copper production guidance by 6% for the remainder of the year. But wait, there's more on this one, Andrew. It actually got worse because they announced the extension of the Highland Valley Copper Mine in BC. And in addition, the CapEx budget surged by almost $4 billion or 18%. So as expected, tech shares are trading down today.
You think people are just wary that they're putting $2.5 billion into a mine extension, just not delighted with the capex cost?
It's a combination of that and recent results and lowering of guidance, which will reduce earnings per share for this year. If we look at consensus earnings per share for this year, it's already dropped by more than 10%, and we expect that to continue to sink. And ultimately, stocks are priced off of future earnings, and if those are declining, then the share price will fall too.
It's got to be disappointing for shareholders in tech with this big rally in U.S. quoted copper prices this year because of Trump's tariffs. But the tech stock down 17% so far this year.
Yeah, certainly it hasn't matched at all the rally in copper prices here. So sometimes when looking at commodity investing, your more straightforward way to get exposure, whether it's gold or silver or copper, is sometimes you just want to buy the underlying commodity.
Right. Yeah, that is interesting. I suppose you could argue that this thing in America with the big premium on copper prices is artificial because of speculation about tariffs, but certainly, yeah, you'd be happy just owning spot copper over the past while.
Yeah, no doubt. And who knows where tariffs are going to go? That's a bit of a tough call on a go-forward basis.
Yeah, we are actually talking to Helen Amos tomorrow on BNN Bloomberg. I forget what time, I'm sorry, but she's a metals expert at BMO. She's a qualified engineer. And we're going to drill into the complexities here because copper comes into America in various forms, but often refined form, whereas the U.S. is a huge exporter of scrap copper because they don't have the smelters. So it's a complex question.
Yeah, no doubt. And clearly, tech shares haven't been the way to play that trend.